Friends, thank you for being here today. What if I told you that the entire green energy revolution, the one governments have staked trillions on, the one that's supposed to save us from climate catastrophe, is built on a metal that no longer exists in sufficient quantities? Not theoretically, not in some distant future. Right now, in 2026, the hydrogen economy, the fuel cells, the clean energy mandates that are kicking in as we speak, all of it requires one critical element, and that element is vanishing from the earth faster than we can extract it. We're talking about platinum, not gold, not silver, platinum. The metal that's trading at a 60% discount to gold right now, at the exact moment it's becoming the most functionally critical asset on the planet. Gold sits in a vault at $3,400 an ounce. Platinum, the metal we actually need to build the future, trades at $1,350. This isn't just a price anomaly. This is a mathematical scream. The market is pricing platinum like it's a useless relic at the precise moment it becomes the beating heart of the next industrial revolution. Let me give you a number: 230 gigawatts. That's the target for hydrogen electrolysis capacity by 2030. To hit that number, deployment must increase 300-fold in just 7 years, 300 times. And every single one of those systems requires platinum as the catalyst. There is no substitute. There is no workaround. There is no technological miracle waiting in the wings. You need platinum to split water into hydrogen fuel. And right now, the only place that produces 80% of the world's supply is in the process of turning off the lights. This is what I call a geological squeeze. You cannot print platinum. You cannot stimulate it into existence. You cannot have a central bank meeting and decide there will be more of it. You can only dig it out of the ground. And the mines, the actual physical shafts where this metal comes from, are closing faster than we can open new ones. We are walking into what I can only describe as a green energy heart attack, and almost nobody is paying attention. The platinum market has been in deficit for 3 consecutive years. 2 million ounces of shortfall. Gone, not coming back. The above-ground stocks, the vaults in London and Zurich where the physical metal sits, have plummeted by 42% since 2023. We are down to just 5 months of demand cover, 5 months. That's the buffer between functioning industrial civilization and a scramble for a metal that factories cannot operate without. And here's the paradox that should keep you awake at night. Gold is for fear. It's for hoarding. It sits in vaults doing nothing. Platinum is for the future. It's for building. It's the metal that catalyzes the hydrogen reaction, that purifies exhaust gases, that makes the clean energy transition physically possible. So why is the metal we need to build trading at a 60% discount to the metal that just sits there? The market is telling you platinum is worthless at the exact moment the laws of physics are screaming that it's irreplaceable. Let me take you back to where this story really begins, because nothing that's happening now is an accident. This is the final act of a structural tragedy that started 18 years ago. And if you don't understand the genesis, you won't understand why the collapse is inevitable. The year's 2008. South Africa, which provides roughly 80% of the world's platinum, faces a crisis. Escom, the state-run utility, begins what they euphemistically call load shedding, rolling blackouts. The power grid cannot support the demand. And here's what most people don't understand about platinum mining. It's not like drilling for oil. These are deep-level mines. Some of the shafts go down 3 kilometers into the earth. At that depth, the rock temperature exceeds 60 degrees Celsius. Without massive amounts of electricity to run ventilation and cooling systems, these mines become death traps. You cannot send workers down there. The mines must close. In 2008, South Africa had 81 operational platinum shafts. Today, in 2025, that number has collapsed to 53, a 35% reduction. The infrastructure is aging, the power supply is unreliable, and the cost to maintain these operations has become unsustainable for many producers. This isn't a temporary disruption. This is a structural dismantling of the supply chain happening in real time while demand is about to go parabolic. Now, let me explain the mechanism that makes this crisis unavoidable, because this is where the simple logic of household economics completely breaks down. Think of platinum as the catalytic heart of the hydrogen economy. When you want to produce clean hydrogen fuel, you use a process called PEM electrolysis, proton exchange membrane technology. You run an electrical current through water, and the water molecules split into hydrogen and oxygen. But here's the catch. That reaction doesn't just happen on its own. You need a catalyst, something that facilitates the molecular breakdown without being consumed in the process. That catalyst is platinum. There is no scalable substitute. Engineers have tried. They've experimented with cheaper alternatives, with ways to thrift the platinum, use less of it per unit. But they keep hitting a physics wall. Below a certain threshold of platinum loading, the system efficiency collapses. The reaction slows down. The energy input required skyrockets, and the entire economic model of hydrogen production falls apart. You cannot cheat the periodic table. And here's where this gets truly interesting, because while you were watching the stock market, while you were tracking Bitcoin or tech stocks or whatever the financial media was breathlessly covering, the biggest platinum miner in the world quietly admitted defeat. Anglo American, one of the legacy giants of the mining industry, announced they are demerging their platinum division. They're calling it Valterra Platinum, and they're essentially cutting it loose, spinning it off, exiting the risk. What does that tell you? It tells you that even the people who own the mines don't believe the economics work anymore. They're walking away, leaving the market to fend for itself, right as demand is about to spike. This leads us to the system's most crucial secret, which we will explore in devastating detail. But first, you need to understand that we've now entered the escalation phase. The foundation is cracked. The warning signs are no longer subtle. They are screaming at us from multiple directions simultaneously, and the people who are supposed to be managing this crisis are either asleep at the wheel or complicit in the illusion. January 1st, 2026. That's today's date, and today marks the moment the balanced market myth officially explodes. For months, the forecast from major mining analysts claimed that 2026 would bring equilibrium to the platinum market. Supply and demand would balance out. The deficit would stabilize. But those forecasts relied on perfect conditions. They assumed smooth trade flows. They assumed ETF holders would continue selling their positions to flood the market with supply, and they assumed industrial demand would remain elastic, that buyers could simply reduce consumption if prices rose. Every single one of those assumptions is now collapsing. Trade tensions are rising, not falling. Tariff threats and supply chain nationalism are making cross-border platinum flows more complicated. ETF liquidation has slowed to a trickle. And most critically, industrial demand isn't elastic anymore. It's inelastic. That means companies must buy platinum regardless of price, because without it, their factories stop. Their products cannot be manufactured. Their government mandates cannot be met. Let me show you the canaries in the coal mine, because these aren't theoretical warnings. These are actual failures, actual breakdowns happening right now in the real world. First canary, Bocconi Mine. This operation suspended production in late 2025, not because platinum prices were too low, prices were actually rising. They suspended because they couldn't scale operations profitably. Even with higher prices, the cost structure of keeping these aging mines running had become untenable. That's a warning that even financial incentives can't overcome structural decay. Second canary, Amandelbolt and Modiqua. Anglo American halted operations at both of these shafts after fatalities. Safety stops. The infrastructure is so old, so degraded, that it's becoming too dangerous to mine aggressively. You cannot push production when the physical reality is that workers are dying underground. This is the mining industry's version of a heart attack. The system is shutting down its own extremities to preserve the core. Third canary, and this one is the most revealing, the lease rate. If you want to borrow physical platinum, not paper contracts, not futures, but actual metal, the cost has spiked to 12%. 12% up from 1% just months ago. Do you understand what that means? That means there is a frantic scramble happening behind the scenes. Institutions, manufacturers, someone with deep pockets is desperately trying to secure physical platinum, and they're willing to pay 12% annually just to borrow it. That's not normal market behavior. That's panic dressed up in financial jargon. Now, let me show you the trap, because this is where the encirclement becomes total. There is no escape route. If we build the hydrogen economy, if governments follow through on their mandates, if the Green New Deal actually happens, if fuel cell vehicles and hydrogen infrastructure get deployed at scale, then platinum demand explodes. The deficit widens. Prices go parabolic. The squeeze intensifies. But here's the twist. Even if we don't build the hydrogen economy, we still face a crisis. Why? Because without that demand growth, without the promise of higher future prices, the mines have no reason to invest in new capacity. They'll continue shutting down unprofitable shafts. They'll continue running existing operations in care and maintenance mode, which is mining industry language for keeping a mine on life support, not actually producing. The supply will continue to shrink. And when the demand eventually does arrive, because the energy transition isn't optional, it's mandated by law in multiple jurisdictions, there will be no supply to meet it. The stockpile has done its job. For years, the above ground stocks in London and Zurich acted as a buffer. When mines couldn't produce enough, the vaults released metal into the market. That valve kept prices stable. It prevented panic, but that valve is now empty. We've drained 42% of the stockpile in just 3 years. We're down to 5 months of cover. And once that's gone, there is no backup plan. The market will be naked, exposed to the raw reality of geological scarcity meeting industrial necessity. The liquidity tide is going out, friends, and we are about to find out who has been swimming naked. The platinum market has been living on borrowed time, borrowed metal, borrowed assumptions about supply that no longer reflect reality. And in 2026, all of those illusions are vaporizing simultaneously. Now I need to show you something that most people have completely missed because they're looking at the wrong metrics. They're watching gold hit all-time highs. They're celebrating their portfolios going up, but they're not asking the right question. The question isn't, why is gold so expensive? The question is, why is platinum so cheap? The ratio, that's what we call it in the precious metals world, the gold to platinum ratio. Historically, these two metals traded at rough parity, 1-to-1. Sometimes gold would trade at a slight premium. Sometimes platinum would command more. But the relationship was stable because the market understood that both metals were rare. Both were precious. Both had industrial and monetary functions. Today, that ratio sits at 2.5 to 1. Gold is trading at 2.5 times the price of platinum. That's not just unusual, that's a historical aberration. That's the market screaming at you that something is catastrophically mispriced. Let me put this in concrete terms. Gold is currently around $3,400 per ounce. Platinum is $1,350. The gap between them is over $2,000. $2,000 per ounce of divergence. And here's what you need to understand. Gold's primary function right now is monetary. It's a fear hedge. It's what you buy when you don't trust central banks, when you don't trust fiat currency, when you want to preserve wealth across time. That's valuable, absolutely. But platinum is functional. It doesn't just sit in a vault. It goes into catalytic converters. It goes into fuel cells. It goes into the machines that make the hydrogen economy possible. It has industrial utility that cannot be replicated. So when the market tells you that the fear metal is worth 2.5 times more than the functional metal, you should be asking yourself, is platinum worthless, or is it the most undervalued asset on Earth? The hydrogen mandates, the laws that are now in effect, not proposed, not theoretical, but actual enforceable regulations, tell us platinum is not worthless, which means we're looking at the biggest arbitrage opportunity in precious metals history. But here's where the psychology becomes fascinating, because this is where your own mind will betray you if you're not careful. Human beings are hardwired to believe tomorrow will look like yesterday. We call this normalcy bias. You look at platinum's price chart for the last 5 years and you see a metal that's been unloved, ignored, left behind while everything else rallied. Your brain tells you this is cheap for a reason. The market is efficient. If platinum were valuable, it would be expensive. That's the trap. The market isn't pricing platinum based on future scarcity or future demand. It's pricing platinum based on past patterns, past relationships, past assumptions about supply that are now fundamentally broken. The market is looking in the rearview mirror while driving into a wall. Let me show you what's happening beneath the surface, because the forensic evidence is undeniable once you know where to look. South Africa's operational capacity isn't just declining, it's collapsing at an accelerating rate. The number of shafts has dropped from 81 to 53, yes, but that number doesn't tell you the full story. The remaining shafts are older, deeper, more expensive to operate, and more vulnerable to infrastructure failure. Eskom's power grid isn't getting better. Load shedding continues, and the capital required to open new mines or rehabilitate old ones has become prohibitively expensive. Here's a number that should terrify you. It takes approximately 10 to 15 years to bring a new platinum mine from discovery to production. 10 to 15 years. Even if someone decided tomorrow to invest billions in opening new capacity, even if the permitting went smoothly, even if they found viable deposits, we wouldn't see meaningful new supply until the late 2030s. The demand spike is happening now in 2026. The hydrogen mandates are in effect. The automotive manufacturers are committing to fuel cell production. The industrial buyers cannot wait a decade for supply to materialize. And this is where the sovereign failure becomes existential. South Africa isn't just dealing with technical problems. This is a systemic breakdown of state capacity. The government cannot keep the lights on. The infrastructure is decaying. The mining industry, which was once the backbone of the South African economy, is now fighting for survival. And platinum, which represents 80% of global supply, is concentrated in this one failing state. There is no geographic diversification. There is no backup supplier. Russia produces some platinum, yes, but Russian supply comes with geopolitical risk and sanctions exposure. Zimbabwe has deposits but lacks the infrastructure and capital to scale production quickly. The market's entire supply chain runs through a country whose electrical grid is collapsing. Let me introduce you to a concept that will change how you think about this crisis: inelastic demand. In normal markets, when prices rise, demand falls. People substitute cheaper alternatives. They delay purchases. They reduce consumption. That's elastic demand. But platinum demand in the hydrogen economy is inelastic. Why? Because government mandates remove the buyer's choice. If the European Union mandates that a certain percentage of new vehicles must be hydrogen fuel cell vehicles by 2028, then automotive manufacturers must produce those vehicles. And to produce those vehicles, they must buy platinum. They cannot substitute, they cannot delay, they cannot reduce their consumption without breaking the law and losing market access. This is the convergence I've been warning you about. Three distinct forces hitting simultaneously, and each one makes the others worse. Force 1, structural deficit. 2 million ounces missing over 3 years, and the gap is widening. Force 2, sovereign failure. South Africa's grid cannot support deep-level mining, and the infrastructure degradation is accelerating, not stabilizing. Force 3, mandated demand. Governments have passed laws that force industrial buyers to purchase platinum regardless of price, removing the natural demand elasticity that would normally cap price spikes. When these three forces converge, you get what I call a squeeze, not a correction, not a rally, a squeeze. That's when the market realizes there isn't enough physical metal to meet legally mandated demand, and the scramble begins. We saw this in palladium in 2019. Palladium, which is platinum's sister metal, used in gasoline engine catalytic converters, went from around $500 an ounce to nearly $3,000 in less than 2 years. Why? Because the market suddenly realized that emissions regulations were getting tighter, demand was inelastic, and Russian supply disruptions created a deficit. The squeeze was brutal. Automotive manufacturers were forced to pay whatever price the market demanded because they couldn't build cars without it. Platinum is setting up for the same dynamic, but the scale is larger. The hydrogen economy represents trillions in committed capital. The mandates are broader. The supply situation is worse. And the above-ground stocks that cushioned the palladium squeeze don't exist anymore for platinum. We've already drained the buffer. Now let me show you the money illusion in action, because this is where people get trapped by their own success. Let's say you bought gold 3 years ago at $1,800. Today it's $3,400. You've made 89% on paper. You feel rich. You feel vindicated. But here's the question. Are you wealthier, or do you just have more expensive paper? If the dollar is losing purchasing power due to inflation, if the cost of energy, food, and housing is rising faster than your gold gains, then you're not actually richer. You're just keeping pace with monetary debasement. You've protected wealth, but you haven't created it. Now contrast that with platinum. You buy platinum today at $1,350. The hydrogen squeeze happens. Supply deficit becomes undeniable. Industrial buyers start bidding against each other for limited physical metal. Platinum doesn't just catch up to gold, it surpasses it, the way it did historically. Platinum goes to 3,000, 4,000. You're not just protecting wealth, you're capturing a structural repricing of a critical industrial commodity that the market dramatically undervalued. This is not speculation. This is not a gamble on some new technology or unproven thesis. This is arithmetic. You cannot build the hydrogen economy without platinum. The mandates are already law. The supply is already in deficit. The stockpiles are already depleted. The only variable is time. How long can the illusion persist before reality forces the repricing? And here's what keeps me up at night. The lease rate tells us that reality is already breaking through. 12% to borrow physical platinum. That means someone, somewhere, knows this is coming. They're paying an extortionate rate to secure metal now because they understand that in 6 months, 12 months, 18 months, there may not be any physical platinum available at any price. The smart money isn't waiting for confirmation. They're positioning now, while the crowd is still distracted by gold's all-time highs and Bitcoin's volatility and whatever narrative the financial media is pushing this week. Let me tell you what Anglo American's demerger really means, because the official explanation is carefully sanitized corporate language. They say they're streamlining operations and focusing on core assets and unlocking shareholder value. That's public relations. The truth is simpler and more brutal. They're cutting loose an asset they believe is more risk than reward. Anglo American has been in the platinum business for over a century. They understand the geology. They understand the economics. They understand the South African political risk, and they've decided to exit. Now, you might think, if the biggest miner is leaving, doesn't that mean platinum is a bad investment? No. It means the mining business is broken, but the metal is about to become scarce. Anglo American doesn't want to be in the business of running unprofitable shafts with aging infrastructure in a country with an unreliable power grid, but the industrial buyers don't have that choice. They need platinum whether Anglo American produces it or not. The company is exiting the supply side. That doesn't eliminate the demand side. It makes the supply crisis worse. This is the architectural collapse happening in slow motion. The foundation of the platinum supply chain, reliable production from stable jurisdictions with long-term investment horizons, is crumbling. And instead of building new foundations, the major players are abandoning the structure entirely. They're letting the market fend for itself. And when the hydrogen mandates force industrial buyers into the market looking for metal that no longer exists in sufficient quantities, the price discovery is going to be violent. Friends, we are not talking about a normal commodity cycle. We are not talking about a temporary shortage that will resolve itself when prices rise and new supply comes online. We are talking about a geological reality colliding with political mandates, and the time horizon for new supply is measured in decades while the demand spike is measured in months. Now we arrive at the moment of truth. And this is where I need you to stop thinking like an investor and start thinking like a survivor. Because what's coming isn't just a market event. It's a forced choice between two worlds, the world of paper wealth and the world of physical reality. And the gap between those two worlds is about to become unbridgeable. Let me ask you a question that cuts through all the noise. Do you own assets, or do you own claims on assets? Do you hold physical metal in your possession, or do you hold shares in an ETF that promises you exposure to metal? Do you own land, or do you own a REIT that owns land? Do you control the thing itself, or do you control a piece of paper that says you're entitled to a share of the thing? This distinction, which seemed academic during the decades of monetary stability, is about to become the only distinction that matters. Here's why. When the platinum squeeze hits, when industrial buyers realize they cannot meet their mandated production targets without physical metal, They're not going to bid up ETF shares. They're going to demand delivery of actual platinum. And when they do, the whole edifice of paper claims is going to be stress tested in ways it has never been tested before. How many ETF shares exist versus how much physical platinum is actually in the vaults? How many futures contracts are traded versus how much metal can actually be delivered? The ratio between paper claims and physical reality is about to be exposed, and I promise you it will not be pretty. This is what I mean by stepping out of the line of fire. Gold at $3,400 an ounce is fully priced. It reflects all the fear, all the monetary debasement, all the geopolitical uncertainty that's already happened. You're not early to gold, you're late. You're buying at the top of a recognized trend, paying a premium for safety that everyone else has already identified. That doesn't mean gold will fall. It might continue rising, but it means your upside is limited by the crowd that's already there with you. Platinum at $1,350 is mispriced. It reflects none of the structural deficit, none of the hydrogen mandates, none of the supply collapse that's unfolding in real time. The market is treating platinum like it's abundant, substitutable, and unnecessary. The laws of physics and the laws now in effect in multiple jurisdictions tell you the opposite. This is what we call asymmetric opportunity. Your downside is limited because platinum has industrial utility and will always have baseline demand. Your upside is theoretically unlimited because the squeeze, when it comes, has no natural ceiling. When you cannot build the machines without the metal and the metal doesn't exist, price becomes irrelevant. You pay what you must pay. Let me walk you through the psychology of what happens next, because understanding the sequence will help you act before the crowd realizes what's happening. Phase one is denial. We're in that phase now. The market sees the deficit numbers, sees the mine closures, sees the stockpile depletion, and tells itself a story. Supply will adjust, demand will moderate, the market will balance. This is normalcy bias at its most powerful. The system has always balanced before, so it will balance again. Phase two is recognition. This happens when a major industrial buyer, let's say Toyota or Hyundai or one of the European automakers, publicly admits they cannot secure sufficient platinum to meet their fuel cell production targets. Or when a government announces that hydrogen infrastructure projects are being delayed due to supply chain constraints. That's the euphemism they'll use. Supply chain constraints. What they mean is we can't find the metal. Once that admission goes public, the narrative shifts overnight. Phase three is panic. This is when every industrial buyer who was waiting, who was hoping prices would come down, who was assuming supply would materialize, simultaneously realizes they need to secure metal now. The buying pressure becomes self-reinforcing. Each purchase drives the price higher, which triggers more panic buying, which drives the price higher still. We saw this exact dynamic in palladium. We saw it in rhodium. We'll see it in platinum, but the scale will be larger because the hydrogen economy represents a bigger shift than any single automotive technology change. Phase four is the reset. This is when the market accepts the new reality. Platinum isn't a precious metal trading at a discount to gold. Platinum is an industrial metal trading at a premium to gold because it's functionally irreplaceable and structurally scarce. The ratio doesn't just revert to 1 to 1, it inverts. Platinum becomes more expensive than gold, the way it was for most of the 20th century, because the market finally understands that you can hoard gold in a vault forever, but you need platinum to make civilization function. Now, here's where this gets personal, because I need you to understand something about timing. You cannot wait for confirmation. You cannot wait for the financial media to tell you this is happening. You cannot wait for your financial advisor to recommend platinum. By the time the consensus recognizes the squeeze, the metal will already be unavailable at reasonable prices. The lease rate at 12% is telling you that the smart money is already moving. They're not waiting for phase 2. They're positioning in phase 1 while everyone else is still in denial. This is the binary choice I'm putting in front of you. Do you want to hold gold at all-time highs or platinum at multi-decade lows? Do you want to own the fear metal that everyone already owns or the industrial metal that everyone has forgotten? Do you want to preserve wealth or do you want to capture the repricing of a critical commodity that the market has catastrophically undervalued? Let me be explicit about what I'm advocating here because I don't want there to be any confusion. I'm not telling you to sell all your gold. I'm not telling you to abandon your stock portfolio or your real estate or your bonds. What I'm telling you is that a portion of your precious metals allocation, the portion you're holding specifically as a hedge against systemic instability, should rotate from gold into platinum. Swap the vault metal for the factory metal. Swap the fully priced asset for the underpriced asset. Swap the metal that sits and waits for the metal that works. And here's the critical part. You want physical, not ETF shares, not mining stocks, not futures contracts. Physical metal that you can hold, that you can store, that cannot be vaporized by a brokerage failure or a liquidity crisis or a regulatory change. When the squeeze comes, paper claims will be worth whatever the weakest counterparty in the chain is worth. Physical metal will be worth whatever the highest bidder is willing to pay. That difference, that gap between paper and physical, is where fortunes are made and lost. Now, let me address the elephant in the room because I know what some of you are thinking. If this is so obvious, why isn't everyone doing it? Why isn't platinum already expensive? And that's the right question. The answer is that markets are not efficient in the short term. They're efficient eventually, but eventually can take months or years. Right now, platinum is unloved because it's been unloved for 5 years. The momentum traders left, the hedge funds moved on, the retail investors never paid attention in the first place. Gold has the narrative, gold has the momentum, gold has the media coverage. Platinum is forgotten, ignored, left behind. But structural imbalances don't care about narratives. They don't care about momentum. They care about supply and demand, physics and geology, mandates and scarcity. And all of those fundamentals are screaming that platinum is mispriced. The market will eventually recognize this. The only question is whether you recognize it first. Let me give you the framework for thinking about this trade because this isn't a speculation. This is a structural arbitrage. You're buying a metal that's in deficit, trading at a historically unprecedented discount to its sister metal, with demand about to spike due to government mandates and with no possibility of meaningful new supply for at least a decade. Those are facts, not predictions. The only assumption you're making is that markets eventually price assets based on supply and demand fundamentals. If you believe that, if you believe that scarcity eventually creates value, then platinum at 1350 versus gold at 3400 is the trade of the decade. And here's the beautiful part. You don't need to be right immediately. You don't need the squeeze to happen next month. Platinum's downside is protected by its industrial utility. Even in a recession, even in a deflationary collapse, platinum has baseline demand from catalytic converters, from chemical processing, from industrial applications. It's not going to zero. It's not going to 500. The floor is solid. But the ceiling is wherever the panic takes it, when industrial buyers realize they cannot build the hydrogen economy without it. This is what I mean when I say history favors the prepared. You don't prepare after the crisis hits. You prepare while everyone else is still comfortable, still confident, still convinced that tomorrow will look like yesterday. The market is giving you a gift right now, the opportunity to buy a critical industrial metal at Depression-era prices at the exact moment that structural forces are aligning to create a supply squeeze. This gift will not last. The window is closing. So here's my challenge to you, friends. Go look at your portfolio. Look at your precious metals allocation. Ask yourself, am I positioned for the world as it was or the world as it's becoming? Am I holding assets that the crowd already recognizes, or am I positioned ahead of the recognition? Am I paying all-time high prices for safety, or am I buying structural value at distressed prices? The choice is yours, but understand that choosing to do nothing is itself a choice. Choosing to stay in gold at 3,400 is choosing to accept limited upside. Choosing to ignore platinum at 1350 is choosing to ignore the biggest supply-demand imbalance in the precious metals complex. The market is handing you asymmetric opportunity wrapped in a bow, and most people won't take it because it doesn't feel safe. It doesn't have momentum. It doesn't have the narrative. But that's exactly why it works. That's exactly why the opportunity exists. By the time it feels safe, by the time the momentum is there, by the time the narrative is consensus, the trade is over. You'll be buying platinum at $3,000 an ounce, chasing a move that's already happened, paying up for recognition that's already priced in. The geological squeeze is not a theory. The mandated demand is not a prediction. The supply deficit is not speculation. These are mathematical realities unfolding right now, visible to anyone willing to look past the noise and see the structure beneath. The edifice of cheap platinum is crumbling. The foundation of unlimited supply is breaking. And when it fully collapses, when the market wakes up to what's already happening, there will be no gentle repricing. There will be a scramble. Friends, the window for preparation is closing. The smart money is already moving. The lease rates are already spiking. The mines are already closing. The stockpiles are already empty. The mandates are already law. Every piece of the puzzle is visible, sitting there in plain sight, waiting for you to put it together. History favors the prepared. And the prepared are not the ones who wait for confirmation. The prepared are the ones who act when the opportunity is still available, when the asymmetry is still extreme, when the crowd is still looking the other way. That moment is now. The question is, will you see it? Thank you for being here today, friends. I'll see you in the next one.